Bismillahirrahmanirrahim. In this video, we will discuss how to analyze the effect of transactions on debt ratios. So, we have an exercise over here. A firm has the following values for the four debt ratios: liabilities to assets ratios, liabilities to shareholder, long term debt to long term capital, and long term debt to shareholder. Now indicate whether each of the following independent transactions increase, decrease, or has no effect on each of the following four debt ratios. So these are the four debt ratios. We will look into the increase and decrease, and then the text states that analysts need to compute all four debt ratios each year because the debt ratios are highly correlated. Does your analysis in part A support this statement? Okay, so we are going to split these four components or these four parts in on four different slides, and last one obviously will be discussing in the end. So, if we look into the exercise, we have the liabilities to shareholders' equity, long-term debt to long-term capital ratio, long-term debt to shareholder, and we have the first situation where the firm issued long-term debt for cash. Now, we are going to go through some steps to determine how issuing long-term debt for cash affect each of the four ratios, and we will assume a simple balance sheet that you can see over here, and we have the assets, we have the liabilities, we have the long-term debt, the shareholder equity, and the long-term capital of 140. Now, we have the ratios, that is liabilities to total assets. So liabilities to total assets is 100. We have the total liabilities as equal to 100, and the assets are total assets are equal to 200 in this question, in this situation. So this is equal to 0.5. The liabilities to equity is 100 over 100, so that is equal to 1. Then long-term debt to long-term capital is equal to 40 divided by 140, and that is equal to say 0.29. And then the long-term debt to equity is 40 over 100, and this is equal to 0.4. Now, let us assume that the firm issues 20 for long term debt. So the long term debt is, we are increasing it by 20, so the total is going to be 60 now in this situation. So we have the long term debt of 20, so the assets are also going to increase by 20, and this is going to be equal to 220. The liabilities will also increase by 20, so the total liabilities will be 120. Now equity, this remains unchanged, there will be no impact. Coming to the long term capital, obviously the long term capital is also going to increase by uh, by um, by by 20, and this is going to be 160 now, because the long term debt is 60, so 60 plus 100 is 160. Now we are going to recalculate these ratios. First of all, we have the liabilities to assets ratio. So now this becomes 120 divided by 220. So this is equal to 0.545. So there is an increase in this ratio. Now coming to liabilities to shareholders equity, this is equal to 120 divided by 100. This will be equal to 1.2. This also increases, as you can see, from 1 to 1.2. Then the long term debt to long term capital ratio, this is going to be 60 divided by 160 now. So this is equal to 0.375, and this also increases. Then we have the long term debt to shareholder equity ratio, and this is going to be 60 divided by 100. So this is equal to 0.6, and this also increases. So what we can see that the liabilities to assets ratio increases, liability to shareholders equity increases, long term debt to long term capital increases, and finally the long term debt to shareholders equity also increases. Okay, so this is part 1. What is going to happen? The firm issued long term debt for cash. So in case if they increase by 20, the impacts are already reflected in the explanation. We move on to the second part. We have the same set of information. The only thing is now the firm issued short term debt and use the cash proceeds to redeem long term debt. Treat as a unified transaction. Now this is a restructuring of liabilities. As you can see, there will be no net change in total liabilities or total assets, but it shifts the debt from long term to short term. So let's once again we go through the same set of ratios. So the liabilities to the total assets is 100 upon 200, so that is equal to 0.5. Liabilities to equity is going to be now 100 over 100, that is equal to 1. Now long term debt to long term capital will be 40 over 140, so that is equal to 0.286, and the long term debt to equity will be 40 over 100, that is equal to 0.4. Now suppose the firm has issued a short term debt of 20. So they have a short term debt of 20 now, that they are issuing, and they use it immediately to pay off the long term debt. So now the assets, there is no change on the assets, they remain the same 200. There is no change on the liabilities as well, they remain 100. The short term debt has increased to from 60 to 80, while the long term debt, it has decreased from 40 to 20. Equity remains unchanged, and the long term capital now is going to be the long term debt of 20 plus equity, so that is going to be 120 now. Now we are going to calculate again these ratios. So the liabilities to assets ratio is liabilities to assets ratio will be 100 over 200, that is equal to 0.5. You can see there is no change. The liabilities to shareholders equity is going to be 100 over 100 again, so again there is no change, that is equal to 1.0. And then the long term debt to long term capital, this is going to be 20 over 120, that is equal to 0.167. And the long term debt to shareholder equity will be 20 over 100, that is equal to 0.2. So this also decreases from 0.4 to 0.2. So if we want to summarize, we can see that the liabilities to assets and liabilities to shareholder equity, they remain unchanged, there is no effect, while the other two ratios, long-term debt to long-term capital and long-term debt to shareholder equity, they decrease for these changes. Okay, now let us move on to part C, where the firm has redeemed the short-term debt with cash. So once again, we are going to start with the assumed values. We have the assets, including cash for 200. We have the liabilities of 100. Short-term debt is 60, and the long-term debt is 40. And the long-term capital will be 40 plus 100, that is 140. So once again, we calculate the ratios. The liability to assets will be 100 divided by 200, that is equal to 0.5. Liabilities to equity will be 100 over 100, that is equal to 1. Then long-term debt to long-term capital will be 40 over 140, so that is going to be for 0.286, and the long-term debt to equity will be 40 over 100, that is equal to 0.4. Now let us assume that the firm pays $20 of short-term debt. They are paying $20 for the short-term debt using 20 of its cash. So they are paying the short-term debt by $20. So let us see what happens now. So now because we are paying, so the assets are going to decrease by 20. So this is going to be 180. The liabilities are also going to decrease from 100 to by 20. The liabilities will be 80 now. The long-term debt, they are going to remain unchanged. They remain the same, that is 40. The short-term liabilities, they are going to decrease from what? They are going to decrease by 20. So the short-term debt now is going to be 40. And the equity remains unchanged, that is 100, and the long-term capital will now be 40 plus 100, that is 140. Once again, we are going to calculate these ratios. So the liabilities to total assets will be 80 over 180, that will be equal to 0.44. So you can see that the ratio has decreased from 0.5 to 0.44. The liabilities to shareholders equity will all be 80 upon 100, that is 0.8. So it has decreased again for the liabilities to equity. Coming to long-term debt to long-term capital ratio, that is going to be 40 over 140, that is equal to 0.286. You can see there is no change in this case. And then finally, the long-term debt to shareholders equity will be 40 over 100, that is equal to 0.4. So once again, there is no change in the ratio. So the summary is that the liabilities to asset and the liabilities to shareholders equity, they are going to decrease, while long-term debt to long-term capital and long-term debt to shareholders equity, there is no effect in case if the firm is going to redeem the short-term debt with cash. We move on to the fourth situation where the firm issued long-term debt and used the cash proceeds to repurchase shares of its common stock, and we have to treat as a unified transaction. So now once again, you see if in this case the transaction, they say this is going to increase definitely the long-term debt, and it will decrease the shareholders equity. There will be no change in total assets since cash in is equal to cash out. So it restructures the capital by replacing the equity with the debt. So, so the assets are going to remain the same, that is 200. Coming to the liabilities are going to be 100. of this long term debt is going to be 40 while the short term is 60. Coming to the shareholders equity, it is going to be 100 and the long term capital is 40 plus 140, 40 plus 100, that is equal to 140. So if we calculate the ratios are going to be as follows. We have the liability to total assets, that is equal to 100 upon 200, that is equal to 0.5. Now the liabilities to equity will be 100 over 100, that is equal to 1. Then long term debt to long term capital will be 40 over 140, that is equal to 0.286. And the long term debt to equity will be 40 over 100, that is equal to 0.4. Now suppose as they say, the firm has issued long term debt. They have issued long term debt. So suppose they are issuing a long term debt and they repurchase the equity. So they are issuing, suppose again they are issuing a long term debt of 20, and at the same time they are using this 20 of that cash to repurchase the common stock. So in this case, if you look at the assets, there will be no change as cash in is equal to cash out. Coming to the liabilities are going to increase to 120 as the long term debt increases to 60 now, and the equity is going to be decreasing to 80 because they are repurchasing $20 worth of shares. The long term capital is going to be 60 the long term debt plus 80 the equity. So 80 plus 60 is 140. The short term liabilities, they remain the same, that is 60. So once again we are going to calculate these ratios. So liability to total assets will be 120 divided by the total assets, that is 200, that is equal to 0.6. So it increases from 0.5 to 0.6. The liabilities to shareholders equity will be 120 divided by 80, that is equal to 1.5. So you can see it increases. Coming to long term debt to long term capital, this is going to be 60 divided by 140, that is equal to 0.429. So this also increases from 0.286 to 0.429. And finally, the long term debt to shareholders equity is equal to 60 over 80, that is equal to 0.75, and this also increases from 0.4. So if you look at the summary, the liabilities to assets and the liabilities to shareholder equity, long-term debt to long-term capital, long-term debt to shareholder equity, they all increase if the firm issues a long-term debt and uses the cash proceeds to repurchase the shares of its common stock. Okay. So we have answered all the four parts of part A, and we go to part B now. And what they say is the text states that analysts need to compute all four debt ratios each year because the debt ratios are highly correlated. Does your analysis in part A support this statement? And I have to explain it as well. Now you see, we have gone through the four ratios, and all and this has been put in this table over here. As you can see, the increase and decrease with the changes as they have been suggested in part A. So now, if you look into the first instruction that was there, part number 1, you see all were increasing. And if you look into number 4, you can see they were increasing as well, and this is what has been reflected here, 1 and 4. So all four ratios, they are increasing together. If you look into transaction number 2, here, if you look into the transaction number 2, the ratio is split. You can see that the liability to assets and the liabilities to equity, they stay the same, they don't change, but the long term debt based ratio decreases, as you can see over here. And this can be seen over here as well. You can see that the long term assets and the liabilities to assets and the liability to equity, they stay the same, but the long term debt based ratios, they have decreased. Against this, if you look at transaction number 3, when they are redeeming the short term debt with cash, the long term the liabilities to asset and the liabilities to equity, they have decreased, but the long term debt based ratios, they remained unchanged. So what we can conclude is that the liabilities to assets and liability to equity, um, they are going to move together consistently when goes up or down. So does the other long term debt base ratio, that is the long term debt, long term capital and the long term debt to equity, they move together, also tightly linked. But the two groups, that is total liability ratios versus the long term debt ratios, don't always move the same way. Especially you can see in transaction number 2 and transaction number 3, where one group changes and the other does not. So what and then we as they say, because the debt ratios are highly correlated. So let us see if these ratios are highly correlated. So our analysis does support the claim that some of these debt ratios are highly correlated, especially within each group. You can see that the liability to assets and the liability to equity, uh, they are correlated definitely, and the long term debt to long term capital and long term debt to equity, they are correlated. However, the analysis also shows that we cannot always rely on one ratio to infer the other, especially when the debt is restructured, like short term for long term, or cash is used to adjust only a part of the capital structure. So, what we can conclude is that while the debt ratios are correlated in many scenarios, especially within their respective groups, total liabilities and long term debt, the analysis in part A shows that they don't always move together. This means that while analysts might not need to compute all four ratios every year, relying on just one may miss important details about the firm's debt structure, particularly during strategic financing or refinancing actions. So we hope we are able to explain how to analyze the effect of transaction on debt ratios. This completes the video on how to analyze the effect of transactions on debt ratios. We hope you have enjoyed the presentation, and if you found value in this video, then please like, subscribe and share my channel, and hit the notification bell button to alert you for the latest video. Remember, effective questioning brings insight, which fuels curiosity, which cultivates wisdom. If you have any question or any suggestion regarding this session, then please put them in the comment box below or by email, and inshallah I will reply you back. And regarding the webinars and guest speaker invites, please send me a message at accountingamir@gmail.com. Accounting is a K. Thank you so much and happy learning.